Welcome to the Chapter 10 tutorial on property, plant, and equipment, goodwill, and intangible assets. What we're going to do first is focus on property, plant, and equipment. Now, property, plant, and equipment are tangible assets. And what we mean by tangible is they have a physical substance. And property, plant, and equipment generally have three main characteristics. They're relatively expensive. They're going to last a long time, more than 1 year. And towards the end of its useful life, or when the company doesn't need it anymore, it may sell the property, plant, and equipment or trade it in for something newer. Now, the first thing I want to focus on is what goes into the cost of property, plant, and equipment. And it's not just what you pay for that item, but it's basically all the costs that are to bring the asset to its intended use and also location. Now, here is a list of costs that are typically included in the property, plant, and equipment value. And we refer to this as capitalizing the cost. So any cost that we add to these long-term assets, we're going to capitalize the cost rather than expense them. And so obviously the purchase price is included. If we paid any commissions, any transportation charges, those would be included as well. Any non-recoverable taxes, for example, provincial sales tax, any installation costs, testing, permits, clearing costs for land will also be capitalized or added to the cost of the asset. Now, one thing that the textbook talks about is this concept of land improvements. Now, land improvements is different from land. Land improvements go on top of the land. And the reason we distinguish land improvements from land is that land, we do not take any amortization or depreciation, whereas land improvements, we do take amortization. So accounting rules state that amortization expense is taken on land improvements, but not on land. And so land improvements would be things such as fences, parking lots, sidewalks, landscaping, lighting. Those are things that go on top of the land, and we record them as land improvements, and we do take amortization expense. Whereas land, we do not take amortization expense. Then the textbook talks about the difference between betterments and repairs. Now, when it comes to repairs, we will just expense those amounts. So, for example, if we have a car and we do an oil change, that would be an expense. But if we have a car and we do something to the car that's going to increase the capacity or efficiency of the car, then we would capitalize that amount. And so an example of a betterment would be maybe we rebuild the engine. So we have a car, we've had it for a few years, and then we pay, let's say, $5,000 to rebuild the entire engine. That's going to likely increase the useful life of the car. And so the amount of that cost to rebuild the engine, we would capitalize it, add it to the cost of the car rather than expense it. The first thing I'm going to look at then is exercise 10-1, page 584. And this is going to cover some examples of costs that we capitalize for land improvements, and also a building. So turn to page 584 in your textbook, have a read through exercise 10-1, and once you've completed reading the exercise, then resume the video and we'll work through the solution together. So let's have a look at exercise 10-1. In exercise 10-1, once again, this is on page 584, this company bought some land and they paid all these additional charges. They also constructed an office building, and they also put some fencing and some lighting on the land as well. So what I want to do is show you what goes into each account. So let's just draw a T account. For land, we'll draw a T account for land improvements, and then we'll draw a T account for our buildings. And so once again, these are all going to be long-term assets on our balance sheet. And so now we're going to figure out, well, what goes into each account to include in their costs? Well, when we start off, we bought the land for $350,000. So we know automatically that $350,000 is going to be added to the cost of the land. And then we go on to further, and we're told that We also had to pay property tax in arrears of $3,000. And what that meant was that this land that we purchased was owing property tax of $3,000. And because we paid for that, we're going to include that in the cost of the land. And so that is going to be $3,000. Now, this is the property tax that was owing for the period prior to our purchase of the land. So it's not something that was incurred after we bought the land, but in order to take title of the land, we have to pay for all these additional costs. So we're going to include it in the cost of the land. And then we have a legal fee of $1,500. Once again, that was part of the purchase process, so we have to include that in the cost of the asset. We cannot expense the amount. And then in order to get the land ready for use, we paid a charge of $20,500 to level the land. Once again, that is also added to the cost of the land. Anything that's incurred to get the asset ready for use is going to be added to the cost of that asset. So the total cost of the land on our general ledger, if you add up all these amounts, is going to be $375,000. Now remember, we do not take amortization expense on land. However, for the building, we do. And so the cost of the building was $1.2 million. And so we put that into a separate account. And that's going to be the cost of the building, $1.2 million. And we'll take amortization on the building because it does have the wear and tear factor. Now for the land improvements, some companies will just lump them all together if they're going to have the same useful life. Now you could separate them if you think that the fence might have a different useful life from the lighting. But in this example, we're just going to lump them all together in this one account called land improvements. And so here we put the amount for the fence, which is $30,000. And then we added a sign, $8,500. That goes on top of the land, so that's known as a land improvement. And then also the lighting, $11,500. Now, it does say that during the installation of the fence, there was a $2,000 damage to the fence that was incurred. Now, that would not be included in the land improvement because that was an error. It was a mistake. That $2,000 damage, that was something that was done in error. It was not necessary to actually build the fence. It was a mistake. So that $2,000 can be just expense. And so the only amounts that would go into the land improvements are these three amounts. We would add that together, and then the value of the land improvement asset would be $50,000. And once again, we will take amortization expense on the land improvement and also the building, but not on the land. So that's sort of an example of what goes into the different costs of assets. Let's then go back to our handout and look at the next set of topics. We also have this category called leasehold improvements. Now, leasehold improvements are amounts that a company incurs on assets that they lease. So for example, think about your downtown core. Your downtown core has a bunch of high rises, and all these big companies lease their office space. They normally do not own the office building that they're currently in. They lease the office space. Maybe they sign a 20-year lease. And when they move in, they may decide to do a huge renovation. That renovation may cost $1 million. And so that $1 million renovation, because it's on a leased asset, is known as a leasehold improvement. They cannot expense that $1 million renovation. What they have to do is record it as a leasehold improvement and then take amortization on that $1 million. And the costs are amortized over the term of the lease plus one renewal option or the useful life of the leased asset, whichever is shorter. Now, this is introduced in this course, and you'll learn more about leasehold improvements in an advanced accounting class. So just for this course, just sort of know what a leasehold improvement is and just understand the rules that are involved, but we're not going to get into any complex calculations with respect to leasehold improvements. Just know that these are amounts that are incurred on a leased assets, and you do take amortization expense on them, and the amortization is calculated over the shorter of the lease term plus 1 renewal option, or the useful life of the leased asset. What we're going to do next then is talk about lump sum or basket purchase of assets. And what that means is, let's say you pay one price for a bunch of assets. How do you allocate that one price to all the different assets that you purchase? And we use what's called the relative fair value method. And to demonstrate this, we're going to look at exercise 10-2, page 584. So have a look at exercise 10-2 on page 584. Read through that exercise first, and once you have gone through reading that exercise, then resume the video. So exercise 10-2, this company bought 3 trucks and they paid one price of $60,000, and now they're going to figure out how are they going to allocate that $60,000 to these 3 different trucks, because the trucks may have different useful life, and so they have to calculate the amortization differently for each of the trucks. So what we're going to do then is use what we call the relative fair value method. We're going to figure out what the fair value is for each of the trucks. So we have truck number 1, truck number 2, and truck number 3. Now, we know that the total price paid was $60,000. We want to basically allocate that $60,000 to each of the 3 trucks. And we got to come up with a way that does this logically. So we're going to take the fair value. We know that truck number 1 had an appraised value of $24,000. Truck number 2, an appraised value of $23,000. Oh, sorry, yeah, truck number 2, and then truck number 3, an appraised value of $20,000. So the total appraised value is going to be $67,000. Now, once we have all the fair value listed, what we're going to do is we're going to take the $24,000 divided by the total fair value, $23,000 divided by the total fair value, and we're going to do the same for truck number 3, $20,000 divided by the fair value, the total fair value, or the total appraised value. And then we're going to take and calculate a percentage. And if you actually read the question, it says, round the percent calculations to 2 decimal places. And so if you go 24,000 divided by 67,000, round it to 2 decimal places, this would be 0.36 or 36%. The next one would be 23,000 divided by 67,000. That would be 0.34. And then this would be 0.30. And so what we're going to do then is, now that we have these percentages, and once again, this has to equal 100%. We want to make sure that those 3 percentages equal to 100%, and it does. So then we can take these percentages, and that's how we're going to allocate the $60,000 purchase price. And if we work through these calculations, 36% of 60,000 is going to be 21,600. 34% of 60,000, 20,400. And then the last one, 30% of 60,000, that's going to be 18,000. And that's how we divide the 60,000 into the price of each of the 3 trucks. And so these are the amounts we're going to be using to record the cost of each truck. Now, once we have that, then we can actually go and do the journal entry. So using these 3 amounts, we can then record the journal entry for the purchase of the 3 trucks on February the 1st. So let's just call them truck 1, truck 2, and truck 3. So we're going to debit truck number 1 for 21,600, and then truck number 2 for 20,400, and then the same for truck number 3 using the 18,000. And then we got to figure out, well, how do we pay for the trucks? And when you read through the question, we paid 21,000 cash. So we're going to credit cash for $21,000. And then the remaining was, we signed a note. So we're going to credit note payable for the difference of 39,000. So that would be the journal entry to record the purchase of these 3 trucks. Now, one thing to note is that generally speaking, you should not round till you get to the final answer. But the way that this textbook does it, and also on my accounting lab, is that if the instruction says to round these to 2 decimal places, then you round these to 2 decimal places before moving on. But generally in real life, you should not be rounding till you get to the final answer. But for purposes of the textbook and also for use on my accounting lab, if the instruction says to round the percentages to 2 decimal places, then follow this example that we just did. So that was the relative fair value method. Let's go back to our handout now, and let's look at calculating amortization. So in the textbook, there are 3 methods to calculating amortization. And the 3 methods are straight line, units of production, and double declining balance. Now, companies can use any of these 3 methods when they're calculating amortization expense, but they should be using the one that best matches the use of that asset. And so when we talk about straight line, and this is what we reviewed in the earlier chapter, it's sort of like even wear and tear. You buy a building and you're going to use it for 50 years, and the wear and tear is probably going to be the same over each year. Units of production, if we can actually measure how much we actually use the asset, the units of production would be useful. So for example, if we bought a car and we expect that we're going to be driving it for 200,000 kilometers, that could be the useful life of the car in kilometers. And then we can measure how much we use it based on the kilometers driven per year. Therefore, units of production might be the more appropriate method to calculating amortization expense. And then double declining balance, also sometimes referred to as double diminishing balance. The double declining balance method is used for assets that depreciate really quickly. They lose value very, very quickly. And so, for example, it might be electronics or computers. The value of the computer will depreciate or lose value really quickly within 1 year because newer models will come up. So we take more amortization or depreciation in the first year and then less each year after that. And so the calculation relies on 3 factors. We need to know the cost, the estimated useful life, and the estimated residual or salvage value. The residual or salvage value is what we think we can sell the asset for at the end of its useful life. And so when we talk about useful life, that's the useful life to the company. The company may buy a car, but they only may use it for 3 years, because after 3 years, they may decide that it's going to cost too much to keep up with the maintenance and repairs. The warranty will expire. So the useful life for the car, for the company, might be 3 years, but that's not the useful life for the entire life of the cars. The useful life that we estimate is the useful life as it pertains to the company. So to demonstrate these 3 methods, we're going to look at exercise 10-9 on page 586. And we're only going to do part 1 in this video tutorial. So turn to page 586 and have a read through exercise 10-9. Once you've done reading the exercise, then resume the video to work through the question together. Okay, let's have a look at exercise 10-9. And once again, we're just going to focus on part 1. Now, when you read through exercise 10-9, this company bought a machine on January 2nd. So on January the 2nd, this machine was purchased for $460,000. Now remember we said we need to know 3 items. So we know the cost. Now we got to figure out what's the useful life. And so in this example, we're told the useful life in years and also in how many parts it can be produced. And so the useful life in years is going to be 3 years, or it's going to produce 2 million parts over this useful life. So once again, it's kind of like a car, right? You can say the car is going to be used for 10 years or for 200,000 kilometers. So that's what we're doing with this machine. We're going to use it for 3 years, or once it produces 2 million parts, that's probably going to be the end of its useful life. Now, at the end of its useful life, the residual value, so this residual value also sometimes called the salvage value, is what we think we can get for this machine at the end of its useful life. And it's going to be $10,000. Now we're going to show how to calculate amortization expense for each year. Remember, it's supposed to last for 3 years, given this information, and first using straight line. So we're first going to use straight line amortization or depreciation. Now remember, straight line is even wear and tear. Straight line, the same amount every year. And because we bought this on January the 2nd, we can take the full year of amortization in the first year, 2020. Now to calculate the amortization expense, all we're going to do is take the cost of the machine minus the residual value, which is $10,000, because we think we can get that value for it at the end of the 3 years, and divide it by 3. So if you look at the numerator, this is $450,000. We're only going to be taking amortization on $450,000 of the cost because we think we can sell it for $10,000 at the end of the useful life. So when you work through this, it's going to be 450 divided by 3. And so we're going to take $150,000 of amortization expense per year. And let's just sort of show you how this looks in T accounts. So we have the machine, and we're going to put the $460,000 in the machine general ledger T account. And then all the accumulated amortization is going to go into this contra account. So remember, these two accounts are stuck together. In year 1, we're going to take $150,000 of amortization, same in year 2. And then in year 3, we're going to take $150,000. So when you look at the 3 years, after 3 years, the total in accumulated amortization is the $450,000. And so the value that's left at the end of the 3 years, remember that's known as the book value when we take the machine minus the accumulated amortization. The book value, or the carrying value at the end of 3 years, is going to be $10,000, because that's the value we think we can get for it if we sell it at the end of 3 years. And so that's an example of straight line amortization or straight line depreciation. We take the cost minus the residual or salvage value divided by the useful life in years, and we take the same amount of amortization every year. And then at the end of the useful life, what should be remaining, the book value, should equal the residual value. So that's the first method, is straight line. So let's just get this cleaned up now. And then let's look at the second method, which is called units of production. Now, units of production, we should use that if we can measure the use of the asset. So because this machine, we can measure the use based on how many parts we produce each year, then we could use units of production. And once again, all 3 methods are acceptable, but the company should choose the one method that best represents the wear and tear or the use of this particular asset. So for example, a company might use straight line for the building that they own. They might use units of production for the machine and for the car that they drive. And then they might decide to use double declining balance for their computer equipment. So let's talk about units of production. Now, units of production, we have to calculate the amortization rate per unit. And the way we do that is, once again, we take the cost of the asset minus the residual value. There's that $450,000 again, but this time we divide it by the useful life in units. This machine is estimated to produce $2 million, or 2 million parts or units. So we divide it by the 2 million parts or units that we think this can produce. And so this is going to give us an amortization or depreciation rate per unit. So 450,000 divided by 2 million. So each time we produce a part, we're going to take 22.5 cents of amortization, so per part or per unit. And so this is actually fairly easy now. So then we have to figure out then in each year, how many parts do we produce? So in year 1, we're told that we produced 7,000 parts in year 1. And so that means the amount of depreciation or amortization expense we're going to take in year one is 700,000 times 22.5 cents. So we're going to take 157,500 of amortization or depreciation expense in year one. Then we get to year two. Year two, we produce 660,000. And if we work through the calculation, year two, we're going to be taking 148,500 of amortization or depreciation expense. So once again, if we set up the T accounts, we're going to have the machine, 460,000. And then we're going to have accumulated amortization. Year one, that's going to be 157,500. Year two, 148,500. Now, in year three, it gets a little bit interesting because in year three, we actually produce 650,000 parts. Now, remember, we based the calculation up here, the 22.5 cents, on 2 million parts. So if we add up the number of parts that we actually produced, we're actually more. We're actually at 2,010,000. So what that means, if we were to work through this calculation for year three, we would get 146,250. But that would be too much because remember, in our accumulated amortization account, we want to end up with 450,000 because remember, we want the book value at the end of 3 years to equal 10,000, which is the residual value. So if we actually produce more than we actually estimated, then this number for year three is just going to be a plug. We have to figure out, well, how much do we need to get to 450,000? So year one was an actual calculation. Year two, we actually calculated that as well. But for year three, we're not going to use this calculation at 22.5 cents per part because that's going to give us too much. And so if we work this through, the amount that we need to get to 450,000 is going to be 144,000. So in year three, we're going to record amortization expense of 144,000. So let's just double check that. Yeah, and that's going to give us the 450,000. So that would be the number we use for year three. And once again, the only reason for that is that we actually produce more parts than we estimated. And so our estimate was based on 2 million parts. And so we're going to just figure out what we need in year three to get our total accumulated amortization to the 450,000. That's going to leave our book value equal to our residual value. So that's an example of units of production. Let's then clean this up and move on to the third method, which is double declining balance. Now, double declining balance, some textbooks refer to it as double diminishing balance. And we would use double declining balance or double diminishing balance for assets that have sort of, they lose value very, very quickly. And the example I'd used before was computer equipment. Computers, there's always a new model, there's new technology coming out almost every week. And so when you buy a computer, the value is going to drop really quickly. And so we're going to take more amortization expense in the early year and less each year thereafter. Now, going back to this machine, the first thing that we have to do when we're using the double declining balance method is figure out what we call the straight line rate. The straight line rate, we take 100% divided by the useful life in years. The useful life in years is 3. So we divide it by 3. That's going to give us 33.33%. And then we double it. That's why it's called the double declining balance method. Is we take the straight line rate, we double it. That's going to give us 66.23%. And then what we do is we ignore the residual value until later on. So we're going to ignore the residual value, but what we should do is set up our T accounts. We want to make sure that we still end up with the same residual or book value at the end of 3 years. So we're going to start off with the machine at $460,000, and we're going to have our accumulated amortization, and we're still going to take amortization, for the first year, for the second year, and once again, likely for the third year as well. But ultimately, what we want to make sure is that at the end of recording all the amortization, we end up with $450,000 in our accumulated amortization account. Because remember, we still want to end up with a book value of $10,000. So what we do then is in year one, we take the book value of the machine. Now, the book value is going to, because we haven't recorded it in any amortization yet, we're going to just take the original cost of $460 and multiply that by our double declining balance rate. So we multiply it by 0.66667. That's 66 2/3%. And we'll just round it to the nearest dollar. And this is going to give us amortization expense in year one of $306,667. So once again, we take a lot more amortization in the first year if we think that this is an asset that's going to lose value really quickly. So in year one, we have amortization $306,667. Now for year two, we start off with the book value. Well, what's the book value? The book value is the $460,000 minus the balance in accumulated amortization. Well, at the end of year one, the balance in accumulated amortization is $306,667. And then we times it again by the double declining balance rate of 66 2/3%. And this is going to give us the amortization in year two. And so if you work through that, 460,000 minus 306,667 times 66 2/3%. In year two, we're going to have amortization expense of $102,222. Now, what you notice is that we take a lot more amortization in year one, and then every year after it's a little bit less. And so in year two, we update our accumulated amortization account, $102,222. Now is where we have to keep track of what our book value is at the end of year two. So at the end of year two, this is going to be $408,889. Now, if we actually do the calculation for year three, in year three, the book value is $460,000 minus $408,889. And then we multiply that by the double declining balance rate, 66 2/3%. Just do that calculation and let's just see what we get. That's going to give us $34,074. But remember, we want to end up with $450,000 accumulated amortization at the end of year three. So this is actually going to be too little. If we add that to the $408,889, that's not going to bring us up to $450,000. So in year three, rather than use this number, year three will just be a plug. How do we get to where we want to be, the $450,000? Well, in order to get to that, we have to record amortization in year three of $41,111. So the final year is just going to be a plug number. It might be more than what we calculate, or it might be less. That's just going to be a plug number. And so that's how we work the double declining balance rate. So that's an example of the three methods that are shown in the textbook to calculate amortization. So straight line, units of production, double declining balance. Now the textbook goes on to talk about tax amortization, CCA, capital cost allowance. Just know the term. Just know that for tax purposes, when a company is going to file their tax return, they cannot deduct accounting amortization expense. What they have to do is calculate what's called capital cost allowance, which is known as tax amortization, and they're able to deduct that amount. And if you end up taking a taxation course, you'll learn how to calculate capital cost allowance. Now, the last topic on page 1 is, what if you buy an asset partway through the year? How much amortization should you take? Well, you have to prorate it. And this only applies to straight line and double declining balance, because for units of production, you're actually going to measure the amortization based on the actual units you produce. So for straight line and double declining balance, you figure out the annual amortization in that first year, and then you prorate it based on the number of months. But what if you bought the asset partway through the month? Well, the rule is that if you put the asset into use on or before the 15th of the month, you include that month. If you put the asset into use after the 15th, so let's say on the 20th, then you don't take amortization until starting the next month. So let's actually demonstrate that using Starter 10-9 on page 583. So turn to page 583, read through Starter 10-9, and then we'll go through an example using partial year amortization. Okay, let's have a look at Starter 10-9. Now in Starter 10-9, we bought this truck for $4 million, and we bought it on March 31st, 2020. So March 31st, 2020, we bought this truck and it was worth $4 million. Now, we bought it on March 31st. So what that means is we will exclude the month of March. Remember, if we bought it on or before the 15th, we take amortization for that month. If not, we go to the next month. So all we're going to do is take amortization in the first year from April to December. So let's just figure out then what is going to be the amortization for one full year first. Now they use straight line. So we take the 4 million. And remember, a straight line, we subtract the residual or salvage value. This company expects the residual or salvage value to be 400,000. And then we divide it by the useful life of, given in the question, it's going to last 9 years. So every year we would take amortization expense of 400,000 per year. However, in 2020, we only have it for 9 months. So in 2020, we have to multiply this by 9/12. And so if you work through that in 2020, all we're going to do then is take 300,000 of amortization expense in 2020. And so that's all we do. It's fairly easy. Once you work out the yearly amount, you just prorate it based on the number of months. And once again, the rule is if you put it into use on or before the 15th, you include that month. If not, you just wait till the next month. So that's an example of partial year amortization. Now moving on to page 2 of your handout, the first topic is revisions of estimates. Now remember, there's a couple of things that we estimate. We estimate the useful life, and we also estimate the residual value. Well, what if you bought an asset, you put it into use for a few years, and then you realize later on that maybe that useful life estimate that we made when we bought the asset is no longer accurate. Now, if that is the case, then you don't change anything that you've already recorded. You only make the changes going forward. You only make the changes prospectively going forward. Let's take a look at how that is done using Starter 10-11, page 5. That should say actually 583. Sorry, that should say page 583. So Starter 10-11, page 583. Have a read through that question, and then once you've read through it, then resume the video to work through the solution together. So Starter 10-11, once again, this is on page 583. We bought the asset in 2016. So in 2016, we bought this piece of equipment for $250,000. And we use straight line amortization, and at the time that we bought it, we said the residual value was $25,000, and we estimated the useful life to be 15 years. So in 2016 then, using straight line amortization, we took $15,000 of amortization expense. Now we did this for 2016, 2017, and 2018. So we took amortization expense for the first 3 years of $15,000 per year. So let's actually just draw our T accounts. We have this equipment for $250,000, and then the accumulated amortization, every year we took $15,000 of amortization expense. So at the end of 3 years, our accumulated amortization is $45,000. And then in 2019, we said the useful life is not as long as we expected. We revised the useful life to be 9 more years rather than 12. Now remember, in 2016, we thought it was going to last for 15 years. So based on 15 years, it would still have 12 years remaining at the start of 2019. And all we're saying is that that is no longer true. After using it for 3 years, that 12 should now be 9. So we only have 9 more useful life remaining going forward. So what we do then is we have to revise the amortization expense. What we're going to do is figure out what is the book value. What's the book value or the carrying value at the beginning of 2019? Well, that's the $250,000 minus the accumulated amortization of $45,000. So at the beginning of 2019, the book value or carrying amount is $205,000. So we're going to use that number and calculate a revised amortization expense. The residual value has not changed. There's nothing to indicate that the residual value has changed. So it's still going to be $25,000. That's the residual value. And now we're going to divide it by the revised useful life. So the revised useful life remaining is 9. And so what this means is that for the remaining 9 years, if we work through the calculation, we're going to be taking $20,000 of amortization expense per year for the remaining 9 years. And so that's how we deal with revisions to our amortization calculation. We only make the revisions going forward. So then let's then go back to our handout and let's look at the next topic. Now the next topic is disposing of property, plant, and equipment. So we buy equipment, we buy the car, but then we sell it later on. And we may not have actually used it for the entire useful life. We may just decide that we no longer need this piece of equipment or car anymore, so we're going to sell it. Well, what do we need to do? We need to record all the amortization expense to the date of disposal. So it could be a partial year, it could be for a full year. We figure out whether there's a gain or loss, and then we can record the journal entry. And we can go through this by looking at Starter 10-13 on page 583. So read through Starter 10-13 Alpha Communications, page 583. And once you've read through that, then resume the video and we'll work through the question together. So let's have a look at 10-13. Now 10-13, the equipment was bought in 2020. And then they decided to sell it at the end of 2022. So Starter 10-13. What I would always do first is set up your T accounts. Now we know that we bought this equipment and we bought it for $27,500. Now we sold it on December 31st, 2022, and we're told that at that time the accumulated amortization was $10,000. So then at the date of sale, at December 31st, 2022, let's just figure out the book value. So the book value at December 31st, 2022 $27,500 minus $10,000 accumulated amortization. The book value is $17,500. So remember we said there's sort of 3 steps. This accumulated amortization is up to date because this is the amount at December 31st, 2022. So that is all up to date. So we don't have to record any amortization expense because it's been done for us already. Then we should figure out, did we make any money or did we lose any money on the sale? Well, this is where we compare it to the book value. On our books, the value of this asset is $17,500. Now, what did we sell it for? We sold it for $20,000. So did we make any money? And we did, because the value of the asset is $17,500. We sold it for $20,000. So from an accounting perspective, we actually made $2,500. So that's going to help us do the journal entry now. So now we got to figure out, well, how will we record the journal entry when we sell the asset? Well, if you think about it, what are we going to debit? Well, how much cash do we get? We're going to debit cash for $20,000. After we sell this equipment, what should the balance be in these two T accounts? Well, we no longer own the equipment, so these two T accounts need to go to 0. So how do we get this equipment to 0, and how do we get accumulated amortization to 0? Well, for the equipment, we have to credit it, and for accumulated amortization, we have to debit it. So we're going to have to debit our accumulated amortization for $10,000. We're going to credit our equipment for the $27,500. Now, remember, every journal entry, debits must equal credits. So what are we missing here? The amount that we're missing, we have $30,000 in debits. In order to get $30,000 in credits, we need an additional $2,500. That's the gain on the sale of the asset. Because if you think about it, this amount here is the book value, $27,500 minus $10,000. That's the book value, $17,500. So cash of $20,000 minus book value of $17,500. That's going to leave us with a $2,500 credit. Now, credit is like revenue, so therefore we have a gain on sale. Now, this gain on sale is going to show up on our income statement. So it's just like revenue, that's going to show up on our income statement. That's going to increase our net income. So that's how we record the journal entry whenever we dispose of an asset. Now, you could have a loss as well. If you sold it for less than the book value, then you would have a loss, and then that loss would be on the debit side. It would be like an expense. But because this is a gain, it's going to show up on the credit side, just like revenue. So that's an example of the journal entry and the process related to the disposition of property, plant, and equipment. Now, going back to our handout, there's a couple of other items in Chapter 10. One is talking about exchanging property, plant, and equipment. And there's a good example that you can review on your own on pages 568, 569. And then the textbook also talks about accounting for natural resources. For example, an oil well, a timber site, and they actually use units of production, the amortization method that we talked about earlier. And so you can just review that example on page 569, 570 on your own as well. The last two topics in Chapter 10 talk about intangibles. Now, intangibles are assets that have no physical substance. So remember we talked about tangible assets at the beginning? Tangible assets you can see, feel, and touch. Building, equipment, car, land. Intangibles have no physical substance, but they have value. Things such as patents, copyrights, trademark, also goodwill. Those are called intangible assets. Now, for intangible assets, they're also treated as a long-term asset. And if they have a useful, limited life, a legal life, then we will still calculate amortization. And basically, we just use straight line amortization. Now, for most intangibles, the residual value is often 0. And so because of that, we don't need to set up an accumulated amortization account. And we'll go through an example in a couple minutes. Now, if the intangible has an indefinite life, or if it's goodwill. Goodwill usually arises when you buy another business and you pay more for it than what it's worth on paper, then the excess amount is known as goodwill. With indefinite life intangibles, including goodwill, you don't take amortization, you test them for impairment at the end of the year. And in the textbook, they go through an example of that. So I would direct you to your textbook to look at how to calculate goodwill and how to deal with these indefinite life intangibles. What I want to do today to wrap up today's lecture is look at calculating amortization for a limited life intangible, an intangible that has a finite life. And to do that, we're going to look at Starter 10-19 on page 584. So turn to page 584, have a look at 10-19, and then once you read the question, then resume the video to go through the solution together. So let's have a look at 10-19. So Starter 10-19, we're going to buy this patent. And it has a useful life of 5 years, and it has a legal life of 7 years. It's going to expire in 7 years, so that would be its legal life. Now, when we buy the patent, it was on June 30th, 2019. So let's just go through the journal entry. We bought this patent for $45,000. So we're going to set up this new account called patent. Now, this patent is a long-term asset. Let's just put that in brackets here so we know that this is a long-term asset for $45,000. And we paid cash of $45,000. Now we will be taking amortization on this patent, but we're not going to set up an accumulated amortization account because there's no residual value. All we're going to do is just record everything in the patent account. Now, in order to figure out the amortization in this first year, we take the cost of the patent. Now remember, patents indefinite life, patents and intangibles normally have no residual value. So all we do is divide it by the lesser of the useful life or the legal life. And this year, the useful life is 5 years. The legal life is longer, so we take the shorter of the two. And so the amortization is going to be $9,000 a year. But in this example, we bought it on June 30th, so we have to prorate it for 6 months. So we're only going to take $4,500 in this first year. So on December 31st, when we record the amortization expense, we're going to debit amortization expense for $4,500, but we're not going to set up an accumulated amortization. All we're going to do is just credit our patent account. And so that's just going to go directly into our patent account rather than set up accumulated amortization. And once again, the reason for that is that there's going to be no residual value. So we just put all the accumulated amortization directly into the patent account. So that brings us to the end of this Chapter 10 tutorial on property, plant, and equipment, goodwill, and intangible assets. Good luck with your studies.